You've probably heard Warren Buffett's famous investing analogy about the snowball, right? You start small, find some good, wet snow, and just let it roll downhill until it's huge. But what happens when that hill isn't made of things like railroads and soda anymore? What if it's made of digital code and cloud servers? Well, that's what we're going to get into today, bridging that gap between timeless investing wisdom and the tech giants that are running the show now.
Everything, and I mean everything, starts with this one quote. It's probably the most famous investing advice ever. And the key takeaway is that building wealth isn't really about finding the next hot stock. It's about playing defense. It's about protecting what you have. That idea of capital preservation, that's the foundation for everything else we're going to talk about.
Okay, so that's the big question, isn't it? If you're so focused on not losing money, how do you ever actually make any? It's a great question. How do you get that snowball to start rolling and picking up speed? This is where we pivot from just managing risk to understanding the real, powerful engines of creating wealth. And the answer, the secret sauce, is something Albert Einstein might have called the eighth wonder of the world: compounding interest. This is the magic behind Buffett's snowball. It's the wet snow that makes everything stick together and grow, turning tiny beginnings into absolute fortunes over time. So think about it like this. At first, your money is working for you, but pretty soon, the money your money made starts working for you too. And then the money that money made starts working. You get the idea. It's a chain reaction. And that's what creates that incredible, curving upward line of exponential growth, not just a boring, straight.
So how can you get a quick feel for this power? Well, there's a fantastic little mental shortcut called the Rule of 72. All you do is take the number 72 and divide it by whatever your annual interest rate is. The answer is a surprisingly good estimate of how many years it's going to take to double your money. It's super simple, but man, is it an eye-opener.
And check this out. This is where it gets really interesting. Look at the difference a few percentage points makes. At a 7% return, pretty good. You double your money in about 10 years. But if you can get 15%, you're doubling it in less than 5 years. You've literally cut the time in half. Your rate of return is basically the accelerator pedal for your snowball.
So if getting a higher rate of return is the name of the game, how do you find companies that can actually deliver that year after year? For Buffett, it wasn't just about spreadsheets. It was about finding a great business with a deep, durable competitive advantage, something he famously calls an economic moat. He just paints such a great picture with this, doesn't he? The company's profits, its business, that's the castle. And the moat is whatever special thing it has that protects it from invaders, from competitors. The wider and scarier that moat is, the safer the castle is, and the more predictable its profits will be for a long, long time. So what do these moats actually look like in the wild? Well, they can be all sorts of things. Sometimes it's a brand that's so powerful it's just untouchable in people's minds. Or maybe a company is the absolute lowest cost producer. Sometimes it's just a huge pain for customers to leave, creating high switching costs. Or, and this is a big one, it's a network effect, where the service gets better for everyone as more people join. The classic, textbook example of a great moat is Coca-Cola. It was one of Buffett's biggest investments, and its moat was just incredible. First, you had this brand that was known and loved all over the planet. And second, you had this massive, physical, global distribution network of trucks and bottling plants that nobody could just build overnight. It was a fortress.
But here's the thing. The world has changed. A lot. The most valuable castles today aren't protected by trucks and factories. They're protected by digital moats. The things that are essential to our lives now aren't just things we can hold. They're the invisible platforms and infrastructure that our whole digital world runs on.
And that, of course, brings us to these companies. The Magnificent Seven. You know them. They're the titans of the modern economy, and they've built some of the widest, deepest digital moats the world has ever seen.
Now, here's the real key to understanding these companies. Stop thinking of them as just tech stocks. Start thinking of them as modern-day utilities. They're like the new toll bridges. You pretty much have to use Google to navigate the internet, or Amazon and Microsoft's cloud to run a modern business. They've become essential. And look how those classic moat ideas apply here. Apple's moat, insanely high switching costs. Once you're in that ecosystem, it's tough to get out. Meta has one of the most powerful network effects ever created. Amazon and Microsoft literally own the digital land with their cloud services. And NVIDIA, well, it's become the essential arms dealer for the entire AI revolution. That's a powerful moat. All right, so we've identified the new castles and their incredible digital moats. But what does that actually mean in terms of performance? How do we measure the sheer velocity of this growth,
and really see that snowball effect in action?
Well, the best tool we have for that is called the Compound Annual Growth Rate, or CAGR. It's just a way of smoothing out all the crazy ups and downs to see what the true, steady average annual growth rate was over a long period. It's the gold standard for comparing how investments have really done over time.
And, well, this is where it gets kind of insane. Just look at these 10-year returns. These aren't just good numbers. They're life-changing, market-defining numbers. This is what happens when you have a powerful compounding machine protected by a nearly unbeatable digital moat. The results kind of speak for themselves, don't they?
Let's pause on this number for a second. 19,395% in a decade. It's almost hard to comprehend. This is the modern snowball effect on hyperdrive. It shows you the explosive, mind-boggling potential when a company becomes absolutely critical to a massive technological shift like AI.
But after seeing a number like that, it is so easy to get swept up in the excitement and just chase those huge returns. And that's exactly why we have to bring it all the way back to where we started, back to Buffett's #1 rule. Because no matter how fast your snowball is growing, it can melt even faster. Protecting it is job #1.
This right here shows you the brutal, unforgiving math of losing money. A 10% loss? Okay, you need an 11% gain to get back. No big deal. But look down at the bottom. If you lose 50%, half your money, you need to make a 100% return. You have to double your remaining money just to get back to where you started. That is a deep, deep hole to climb out of.
And this chart shows you exactly why that math is so important. You have two portfolios here that have the exact same average return. But the red line is way more volatile. It has bigger ups, but also much bigger downs. The blue line is steadier, and at the end of the day, the blue line wins, and it's not even close. Why? Because it did a better job of avoiding those killer losses. It protected its snowball.
And that really leaves us with the final question, the one for you to think about. We've seen the incredible power of compounding and these new digital moats. But as you're out there looking for that perfect, long hill and that sticky, wet snow, what are you doing to protect your own snowball from the sun? How are you making sure it doesn't melt along the way?